Have you ever wanted to buy a great company like Apple, Microsoft, or Coca-Cola, but wished you could buy it at a lower price? What if I told you there's a strategy that can actually pay you cash while you wait? Most investors think options are risky speculation, but one option strategy is often used by conservative income investors to potentially generate cash flow while trying to buy stocks they already want to own. It's called a cash-secured put. And by the end of this video, you'll understand exactly how it works, when it makes sense, and the expensive mistake many beginners make. Welcome to Accountant Investor. Today we're looking at cash-secured puts, one of the most misunderstood option strategies. Many investors hear the word options and immediately think gambling, but a cash-secured put is fundamentally different. In many cases, it's simply a structured way to get paid while waiting to buy a stock. However, there are risks, trade-offs, and misconceptions that every investor should understand before using this strategy. Let's start with the basics. A cash-secured put means you sell a put option. In exchange, you receive an option premium up front, but you accept an obligation. If the stock falls below a specific price, you may be required to buy the shares. The cash-secured part means you already have enough cash set aside to purchase those shares. Think of it like placing a limit order with a reward attached. Normally, if you want to buy a stock at $90, you place a limit order and wait. You earn nothing while waiting. With a cash-secured put, you're also waiting to buy at $90, but now someone pays you for agreeing to wait. That's the key idea. Let's look at a simple example. Suppose Apple is trading at $100. You would be happy owning Apple at $90. Instead of placing a limit order at $90, you sell a put option with strike price, $90, expiration, 45 days, premium received, $2 per share. Each option contract represents 100 shares, so you immediately receive $2 times 100 equals $200. Now, two things can happen. Scenario 1. Apple stays above $90. The option expires worthless. Nobody forces you to buy the stock. You keep the entire $200 premium. Scenario 2. Apple falls below $90. You are assigned shares. You buy 100 shares at $90. Because you already collected $2 per share, your effective purchase price becomes $90 minus $2, or $88 per share. In other words, you acquired the stock cheaper than the strike price. There are three major reasons investors use cash-secured puts. Benefit 1. Generate income. You collect option premiums. Whether assignment happens or not, you receive cash up front. Benefit 2. Buy stocks at lower prices. If assigned, your effective purchase cost is reduced by the premium received. Benefit 3. Better discipline. Instead of chasing stocks higher, you define your desired entry price in advance. This encourages rational investing rather than emotional investing. And as investors, discipline is often more valuable than prediction. Here's the misconception. Many people think, if I keep collecting premiums, it's free money. It isn't. The premium exists because you're accepting risk. If the stock falls significantly, you'll still be obligated to buy shares. The premium provides a small cushion, but it doesn't eliminate downside risk. Collecting $200 sounds great. Watching the stock fall by $2,000 does not. This is where many beginners get into trouble. Here's the accountant-level insight. Many investors focus entirely on option premiums. Professional investors focus on the underlying business. Before selling a cash-secured put, ask yourself, would I genuinely want to own this company if assigned? Because assignment is not a failure. Assignment is part of the strategy. If you're selling puts on companies you don't want to own, you're effectively getting paid a small amount to accept a potentially large risk. As accountants, we always evaluate the underlying asset, not just the income generated from it. The quality of the company matters more than the premium. Cash-secured puts tend to work best when you already want to own the stock, you have sufficient cash available, you have a long-term investing mindset, you're comfortable being assigned, and the company has strong fundamentals. Examples could include large established businesses that you would be willing to hold for years. The strategy becomes much riskier when investors use it on highly speculative stocks simply because the premiums look attractive. Higher premiums often mean higher risk. Let's compare. Limit order. You wait for your desired price. No income, no premium. Cash-secured put. You wait for your desired price. Receive premium income. accept assignment obligation. Both approaches can result in buying the stock, but only one pays you while waiting. That's why many income-focused investors prefer cash-secured puts. Before using this strategy, remember, risk number 1, the stock can fall far below your strike price. Risk number 2, you may miss gains if the stock rises sharply. Risk number 3, you need sufficient capital to purchase shares if assigned. Risk number 4, selling puts on poor quality businesses can create significant losses. The strategy is conservative only when applied conservatively. The key lesson is this: a cash-secured put is not a way to get rich quickly. It's a disciplined method of potentially generating income while attempting to buy stocks you already want to own. Used correctly, it can improve entry prices and create additional cash flow. Used carelessly, it can expose you to risks you never intended to take. The biggest mistake investors make is focusing on the premium instead of the business. Always remember, you're not just selling an option, you're potentially buying a company. If you found this useful, subscribe to Accountant Investor. And in the next video, we'll explore how cash-secured puts and covered calls combine to create the famous wheel strategy. Thanks for watching.